Assalamualaikum listeners, welcome back with the discussion of corporations again. And today our discussion about the corporation is going to be regarding the dividends, retained earnings, and the income reporting for the corporations. This is chapter number 14 of financial accounting, and this chapter is in continuation of chapter number 13, which was also about corporations. But there we have discussed about different categories of stocks for the corporations. Let's discuss the learning objectives of this chapter. So this chapter includes first learning objectives, in which we will be talking about firstly what are dividends, and then our main focus will be on the first category of dividend, which is cash dividend. Then the second learning objective for this chapter is going to cover the stock dividend, and there is something similar to the stock dividend which is known as the stock split. We'll be talking about that as well. I will end this recording after the first two learning objectives. Learning objective number 3 and learning objective number 4 is going to be covered in second recording of chapter number 14. Let's start our discussion with the first learning objective, which says that how to account for the cash dividend. But before moving into what is cash dividend, we should be very clear about what is dividend actually. So the definition of dividend is it's the distribution. Distribution of what? Distribution of cash or the stock. Stock means shares. To whom? To the stockholders. And how do you distribute? Distribute it on pro rata basis. What is pro rata basis? In proportion to the ownership. The person who is holding more ownership is going to get more cash or more stock as compared to the person who has less ownership in the company. So that's why we say distribution of cash or the stock to the stockholders on proportional basis, proportion to the income basis or pro rata basis. Dividends are basically of four categories. In financial accounting, we discuss first two categories of the dividends, followed by the discussion of splits with the stock dividend. The other two categories of the dividends are the content of intermediate accounting. So, what is cash dividend? Cash dividend is the distribution of the cash to the stockholders on pro rata basis. And usually the cash dividends are reported on quarterly basis, and they are expressed in dollar amount per share. Like let's suppose $0.5 per share cash dividend is declared, or $1 per share cash dividend is declared. So it's basically in the dollar value, and it is denoted per share. Let's move on towards because on this page. So let me just quickly give you an overview regarding the other three types of the dividends as well, and then we will see how the accounting for cash dividend works. So the second category of dividend is known as stock dividend, which we will cover in the next learning objective. So in this type of dividend, the company distributes the shares or the stocks to the stockholders of the company, and the basis is again pro rata. In the property dividend, company distributes the property of company to the stockholders of the company. Now, which property? Property is not building or land. It's actually investments which company have in other, companies' stocks or bonds. So they could be distributed as dividend among the stockholders of the company. And then there is another type that is known as scripts. Scripts are basically promissory note. Promissory note means promises made by the company to the stockholders of the company that in future company is going to give them either cash or stock as dividend. Generally speaking, why companies goes for dividend? Why do companies distribute the cash or stock? Companies distribute the cash or stock as dividend because they want to distribute the earnings of the company among the shareholders of the company, the profit sharing by the owners, it's in form of dividend. So dividend is basically the sharing of the stockholders in the earnings of the company. So what are the earnings? Net income, right? So that portion of net income which is given, which is distributed to the stockholders, that is known as dividend. And rest is where the rest income stays in retained earnings accounts, because retained earnings are earnings which are retained in the business for the future uses purpose. Okay. Let's move on towards the details of cash dividend. So, in cash dividend, the earnings of the company are distributed to the owners of the company in form of cash. So, for a corporation to pay a cash dividend, there are some, some prerequisites or some requirements which should be met before the company distribute the cash dividend. So, what are the requirements company should met? Number one, it should have retained earnings, because if you remember the closing entries you make for the sole proprietorship or the partnership, similar is the case for the corporations as well. All the net income is taken into the retained earnings account first, and then the dividends are paid out of retained earnings. Okay, so if there is a balance in retained earning account, then you can give the dividend. If there is no balance in the retained earning account, or it is in deficit, it has a debit balance, then you cannot give the dividend. Okay, so first thing is retained earnings, payment of cash dividend from the retained earning. It's legal in all states, in all countries. Why? Because companies take all the net income to the retained earning, and then out of retained earning, the dividends are paid out. Since it is cash dividends, the company should have adequate cash. If company is not having enough cash in its bank account, then in that case it cannot give the cash dividend. It should go for other sorts of dividends. And first and most important thing is the board of directors should declare the dividend. The board of directors declares the dividend in form of cash when the company has retained earnings and company has enough cash. Then the cash dividend is declared by the board of directors. Without declarations, company cannot give the dividend to the stockholders. There are some important dates regarding the dividend or cash dividend or any sort of dividend. Three dates are very important. So these dates are known as declaration date. The second one is known as record date. And in case of cash dividend, the third date is known as payment date. What is declaration date? As I mentioned in the previous page, that a board of directors should declare the dividend. So declaration date is that date when board of directors declare the dividend or they authorizes the dividend. As soon as board of directors declares the dividend, dividend becomes a liability for the company because it is being declared now company has to pay. So on the declaration date, company records the cash dividend or the stock dividend and make it its liability. Then comes the record date. On the record date, since the company's shares are freely traded in the market, public companies' shares are freely traded in the market, so companies should update their records that who are the current stockholders, who are the current registered stockholders, so that the actual owner can get the dividend, not the old one who doesn't have shares anymore. So on the record date, company updates its record for the registered stockholders who are eligible for the dividend. So it's just the updation of the name and addresses and all the details. So that's why there is no monetary transaction happening on this date. So no journal entry is passed on the record date. But yes, record date is important to update the records of company regarding the information for the current stockholders. Finally, the payment date comes. Payment date is that date when company ultimately finally pays the dividend to the shareholders in form of cash. So the dividend which becomes a liability on the declaration date, that is paid on the payment date and the cash is reduced. So these are the three dates. Always they come in order. Always the declaration date is first, then the company update it records on record date, and finally the dividend is paid out. We have an example over here for the cash dividend. On December 1st, the stockholder of Media Journal declare a 50-cent per share cash dividend. What is 50 cent? $0.5 per share cash dividend on 100,000 shares of $10 par value common stock. So if $0.5 is per share cash dividend and company has 100,000 shares, the total amount of cash dividend is going to be $50,000. Okay, so cash dividend on 100,000 shares of $10 par value common stock. So the dividend is payable on January 20 of to the shareholders of record of on December 22nd. So let's find out the dates. On December 1st, the directors declared. So this is declaration date. Then dividend is payable on January 20. Dividend should be paid on January 20. So this is payment date to the stockholders of record on December 22nd. So record date is December 22nd. So December 1st comes, then December 22nd, and then the January 20. So December 1st, which is declaration date, board of directors declared the dividend. We just did the calculation over here. So cash dividend gets debit and it becomes a liability for the company to be paid. So dividend payable gets credit. So dividend payable is a liability. What is cash dividend? Why we are debiting it? It is not an expense. It is also not an asset. So what is this? Because cash dividend or any sort of dividend reduces retained earnings have a normal balance of credit. When something reduces retained earnings, we debit it. So cash dividend reduces the retained earnings. That's why we are debiting it, and we will use it in retained earnings statement. Okay, so we debit it because it reduces retained earning accounts. That's why cash dividend or stock dividend gets debit. Then comes the record date, which is December 22nd. No entry will be made because it's just an updation of information of stockholders. Finally comes the payment date, which is January 20. So on the payment date, this liability will be paid off. So liability will get debit because we are paying it, and company is giving cash because it's a cash dividend. So this is how dividend works. Because we are talking about dividends, so we cannot ignore dividend preferences. When I've done the discussion of different types of stocks with you in my previous recordings, in which we talked about common stock. And we also talked about preferred stock, right? And we said preferred stock has a preference over the common stockholders regarding the dividends and regarding the share at the time of liquidation of the company. So we are talking about dividends. So dividend preferences preferred stocks have over the common stockholders. So what is dividend preference? It is the right to receive the dividend before the common stockholders. For the preferred stockholders, in the last chapter when I was discussing the owner's equity section and I talked about capital stock, in that I mentioned that the preferred stock is written like this: 8% preferred stock, then $100 par value. Remember that? So this 8% is a percentage of dividend preferred stock wants. And this is always calculated on par value. Par value of the preferred stock doesn't changes. Also, the dividend percentage is fixed. So every year claim which preferred stock have in form of dividend that doesn't changes because percentage is same and the par value is same. Let's see here. Per share dividend amounts is stated as a percentage of preferred stock's par value, as a percentage of preferred stock par value, or as a specified amount. Sometimes the amount is also mentioned, but mostly it's percentage. I'm talking about dividend preferences, so we cannot ignore the importance of cumulative and non-cumulative dividends. So now let's discuss what is cumulative dividends and what are non-cumulative dividends. Let's recall the concept of cumulative from the statistics perspective, where we talked about cumulative frequency. Cumulative frequency or cumulative is keep on adding every year or every transaction it adds something. So cumulative dividends are those preferred stock dividends which are added if they are not paid in 1 year. It means that let's suppose in 2019 the preferred stock dividend is $1,000, but due to some financial complications company has not declared the dividend, so this dividend was not paid to the preferred stock in 2019. So in 2020, preferred stock needs 2020 dividend, which is 1,000, but they will also want this 1,000 from the previous year, which is arrear or payable from the previous year. So in 2020 as well as 2019 dividend will be paid out, that will be 2,000 together. So this is known as cumulative. So preferred stockholders must be paid both current year dividend and any unpaid prior year dividend, unpaid means arrears, before you give the dividend to the common stockholders. This is known as cumulative dividend. If the preferred stock dividend is non-cumulative, then if in 2019 or any year dividend is not paid, next year it is not added. Next year, only next year dividend is paid. So that is known as non-cumulative. So I think that now this concept is clear that if preferred stock have cumulative dividend and in 1 year some part or full dividend is not paid to them, the next year they will charge the previous year dividend and the next year dividend as well. Whereas in non-cumulative dividend, the unpaid dividend is ignored. It is not cumulated in the next year. Let's see one example regarding the cumulative dividends. Scientific Leasing has 5,000 shares of 7% $100 par value cumulative preferred stock outstanding. So percentage is 7% and the par value is 100. So what is per share dividend? 7% of 100, that is $7 per share. So here also it's written each $100 pays $7 dividend. The annual dividend will be how much? How many shares we have? 5,000 shares. Per share dividend is 7. So 35,000 is the dividend for all the preferred stockholders. The annual dividend is 35,000. If the dividends are 2 years in arrears, means last 2 years dividends are payable, they are still arrears, it's cumulative. So in the current year dividend will be paid, which is 35,000, and also last 2 years. So last 1 year dividend is 35, but they said 2 years. So together 70,000 last year arrears will be paid out. So how much dividend will be paid to the preferred stock? That will be 105,000. This is the total dividend preferred stock will charge. What if it is non-cumulative? Then there will be no concept of area because it's non-cumulative, and in the current year, only current year dividend will be paid. But because this is cumulative, so we have to pay the previous 2 years dividend, and altogether 105,000 will be paid. So this is how the thing differs in case of cumulative and non-cumulative dividend. So what is dividend preferences? You always allocate the cash dividend between the preferred stock and common stock, and who gets first? Preferred stock gets first. So holders of cumulative preferred stock must be paid any unpaid prior year dividends and their current year dividends before the common stock receives the dividend. Let's have an example of allocation. On December 31st, 2017, IBR Incorporation has 1,000 shares of 8% $100 par value cumulative preferred stock. So let's immediately calculate the dividend for the preferred stock. 8% of 100 is $8. How many total shares? 1,000 shares. So 8 is per share. 8,000 is the dividend, annual dividend for the preferred stock. Okay. It also has 50,000 shares of $10 par value common stock outstanding. At December 31st, 2017, the director declares a $6,000 cash dividend. So this is the date, declaration date, December 31st, 2017. So we want a journal entry on the declaration date. How much dividend is declared? 6,000. So cash dividend gets debit 6,000 and dividend payable gets credit 6,000. Do remember preferred stock wants a dividend of 8,000. Okay, this calculation is also here. Now let's show the allocation. So they want us to allocate. I'll come to the 2018 later on, but let's talk about 2017. In the previous slide, we just talked about how much dividend was declared, 6,000. Do we have any information regarding 2016 or 15 that the dividend to the preferred stock was paid or not? There is no such information about that, so there is no errors. How much you will allocate to the preferred stock? They want 8,000. But we don't have 8,000, we have 6,000. So let's pay them 6,000. Is anything left for the common stock? Nothing, because whole amount is paid to the preferred stock. Preferred stock are cumulative. So out of 8,000, only 6,000 is paid out. How much is area? How much is payable? 2,000. So next year, which is 2018, preferred stock will ask for this 2,000 and also the dividend of 2018 itself. So let's read this illustration. At December 31st, 2018, which is next year, IBR declared 50,000 cash dividend. Now let's show the allocation. How much dividend is declared? 50,000. Is there any error? Yes, previous year 2000 was not paid, so we mentioned that. What is the dividend of current year? 8,000 to the preferred stock. So out of 50,000, together 10,000 will be paid out to the preferred stock. Remaining will be given to the common stockholder, which is 40,000. Okay. Let's proceed towards the next topic, which is how to record the journal entry for this 50,000 declaration. So the journal entry for the 50,000 declaration is cash dividend gets debit and dividend payable gets credit. They are asking for the declaration date. Okay. So 50,000, 50,000. We have a do it exercise over here. Let's do it together. Mastermind Corporation has 2,000 shares of 6% $100 par value preferred stock outstanding at December 31st, 2017. At December 31st, 2017, company declared 60,000 cash dividend. Determine the dividend paid to the preferred stock and the common stock under each of the following scenario. So the first scenario is the preferred stock is non-cumulative and the company has not missed any dividend in the previous years. So in 2017, company has declared a dividend of 60,000. Okay. Let's calculate the dividend which is for preferred stockholders. So 6% of 100 is $6. How many shares? 2,000 shares. So 6 multiplied by 2,000. So it's equal to $12,000. This is the dividend preferred stockholders want. Do we have it? Yes, the declared dividend is 60,000. So out of 60,000, 12,000 will be given to the preferred stockholder. Remaining will be given to the common stockholder, which is 48,000. So I did it over here. Preferred stock has dividend of 12,000 and the common stock has remaining dividend that is 48,000. Let's check the next transaction for this. The preferred stock is non-cumulative and company did not pay any dividend in each of the 2 previous years. We don't bother non-cumulative in the previous years. We are worried about previous year non-payments when the dividends are cumulative. So they are non-cumulative, ignore them. Same distribution will be done. 12,000 will be taken by the preferred stock and 48,000 will be taken by common stockholders. Let's move towards the third possibilities. The preferred stock dividend is cumulative and company did not pay the dividend in each of the 2 previous years. Just now we did the calculation for per year dividend for preferred stock. 6% of 100 is $6. 2,000 shares, $6 each. So the preferred stock has a dividend of 12,000 per year. Previous 2 years is area. So 12,000 multiplied by 2, that is 24,000 is area. Remaining 12,000 is for current year, means these are previous 2 years and the current year also they want 12,000. So altogether they want 36,000 dividend. Okay. Do we have it? Yes, the declared dividend is 60,000. So 36,000 will be given to the preferred stockholder, remaining which is 24,000. 60,000 was total cash dividend, 36 is taken by the preferred stock, remaining is for common stockholders. Let's move on towards the learning objective number 2, which is stock dividend. So, in the stock dividend, the company distributes the stocks to the stockholders again on a pro rata basis. So, why does companies issues the stock dividend minus cash dividend? Because company does not have enough cash, might be, or company needs the cash for some other purposes. It does not want to spend the cash. So, instead of giving cash dividend, company is giving stock dividend. Also, it increases the marketability of the corporation stock. Marketability means that things are available to the market. So by issuing the stock dividends, new shares comes to the market and more marketability is there. People can buy easily the stock of the company. Also, emphasize a portion of the stockholders' equity has been permanently reinvested in the business. For this purpose, we need to look into the structure of owners' equity section. If you remember from the previous of the balance sheet, sorry. So from the previous chapter, we have made owners' equity section many times. So the first part is paid-in capital, and the second part is retained earnings. In the paid-in capital, we have common stock and preferred stock. Preferred stock comes first, common stock comes after. Now, when company will issue the stock dividend, new shares will be issued, right? So on one side, stock dividend will reduce the retained earnings because the dividends are paid out of the retained earnings, right? So on one side, stock dividend is going to reduce the retained earnings. On the other side, common stock is going to be increased. Why? Because new shares will be issued. So one part of the owner's equity section is going to be permanently reinvested in form of common stock. This is what they are trying to explain here. So these are the reasons why companies goes for the stock dividend. Now, because we are discussing stock dividend, we should, discuss two more important content about the stock dividend. That is small stock dividend and the large stock dividend. Small stock dividend is the dividend which is having a percentage between 20 to 25% or less than that. So if a company declares a stock dividend whose percentage is less than 20 to 25%, let's suppose Board of Directors declares 13% stock dividend, that is less than 20 to 25. So we call it as small stock dividend. Small stock dividends, when we record them at the fair market value of the stock. Okay. Large stock dividends, they have a percentage of 20 to 25 or more than that. They are greater than actually 20 to 25%. Let's suppose Board of Directors declared 30% stock dividend. So that's the greater. So that is the large stock dividend. We record large stock dividend at their par value. Why do we do that? Because there's an assumption that the small stock dividend will have less effect on the market price of the outstanding shares because less shares will be new because of the less percentage. But large stock dividend has new number which are large in size. In that case, they are going to affect the market value of the shares. So that's why we cannot record them at the market value. We have to record them at par because market value will no more be reliable. Let's move on towards the entries for the stock dividend. Medland Corporation declares a 10% stock dividend on its 50,000 shares of $10 par value common stock. Is it large or small? Look here, 10%. So the percentage is less than 20 to 25%. It's a small stock dividend. We need to record it based on market value. Okay. So the current fair market value of its stock is $15. So this is also clear that the market value is $15. We need to record the journal entry on the declaration date. So let's see how many new shares will be issued. All shares are 50,000. 10% dividend is declared stock dividend. So new shares are going to be 5,000 shares. Okay. Let's record the stock dividend. So stock dividend will get debit. I did this part. This is 5,000 new shares. And what is the market value? 15. So multiplied by 15. So stock dividend gets debit with 75,000. Why we are debiting stock dividend? Because it reduces retained earning. And then we have to credit common stock. But we are not issuing common stock on the declaration date. We still need to update the records on the record date about the new owners. So we will be issuing the common stock on the payment date, or you can say on the issue date. So what shall I credit if I don't have common stock right now? I'll be using a temporary account of common stock which is known as common stock dividend distributable. This account says that these are common stock in form of dividend which we still need to distribute. The characteristics of this account are exactly like common stock. It is mentioned in the equity section with the common stock. It is recorded at the par value or the stated value. Okay. So how many new shares? 5,000 new shares. 5,000 new shares. What is the par value? Par value is 10. So 50,000 common stock dividend distributable. So if for 50,000 you are issuing 75,000 stock dividend, so remaining is what? Remaining is paid in capital in excess of par common stock. That is 25,000. As I said that the common stock dividend distributable is a temporary common stock account and it has the similar characteristics of common stock. So see here under paid in capital under the capital stock section common stock and then immediately that common stock dividend distributable and then the paid in capital in excess will come. Okay. Let's move on towards the entry on the issue date. So in case of a stock dividend, we have declaration date, then we have record date, just like cash dividend, and then we don't have payment date. We call payment date as issue date. Sometimes people refer it as payment date, but basically this is issue date because you issue the common stock on this date, but they both are actually serving like the same date. Okay. So then on the issue date, you're going to issue the dividend. So what we're going to do, common stock dividend distributable will be distributed now. Common stock will be issued. So this credit account will become debit and the common stock is issued. So this amount will be transferred to the common stock account. So what are the effects of stock dividend on the owner's equity section? So let's have a look at it. In our example, before the dividend, the common stock was 500,000. Why? Because if you see the question, they said 50,000 shares, $10 par value. So, common stock, $10 par value, we have 50,000 shares. So, 50,000 multiplied by 10, that is 500,000. We didn't have any information about paid-in capital in excess of par before the dividend. There was nothing in this account. So total paid-in capital was 500,000. Assume that the retained earnings initially were 300,000. So when you add these two, your total stockholders' equity is 800,000. Before the dividend, we have 50,000 shares and the par value was $10. Then what happened? You issue the stock dividend. You are going to issue 5,000 new shares. So what change? Only the change mentioned over here, okay? How much common stock will increase? 5,000 shares at 10 par value. So 50,000 common stock will increase. Also, we get paid in capital in excess of par account. So total paid in capital increased by 75,000. And if you remember your first journal entry, it has decreased the retained earning with 75,000 in form of stock dividend. So retained earnings will be decreasing with 75,000. So can you see one part of owner's equity is increasing and other part is decreasing with the same amount. So there is particularly no change overall in the owner's equity section. But yes, we have new shares, 5,000 more in form of stock dividend, and there is no effect on the par value. Par value is still $10, so that's why I'm saying no change, $0 change. So after dividend, what will happen? My common stock will be 500,000 plus 50,000, 550,000, and I will also get paid in capital in excess 25,000. So total paid in capital will be 575,000. Before stock dividend, my retained earning was 300,000, but it decreases because of the stock dividend. So now my retained earnings are 225,000. If I add these, my stockholders' equity is still 800,000. Number of outstanding shares increased because we issued 5,000 more shares, but there is no change in the par value. Par value is still $10. Okay, so this is how we compare them. So we have a question over here. Which of the following statement about the small stock dividend is true? It's a debit to the stock dividend for the par value of the share issued should be made. Do we debit the stock dividend with the par value in the small stock dividend? No, we debit it with the market value. So this is wrong. A small stock dividend decreases the stockholders' equity. We just saw that the stockholder equity is not changed. So this is also wrong. Market value per share should be assigned to the dividend shares. Yes, we record them at the market value. So this is correct. A small stock dividend ordinary will have an effect on par value of the stock. No, par value doesn't change, it remains the same, right? Another question, in the stockholder equity section, common stock dividend distributable is reported as what? It's a capital stock account. Just immediately after the common stock we mention it. So let's see, it is a deduction from total paid in capital and retained earnings? No, it increases the paid in capital. capital. It's a current liability? No. It is deducted from retained earning? No. It's in addition to the capital stock. After the common stock, we mention this account. So I'm thinking to, yeah, I'm going to end the recording over here, and the stock split and the remaining content in this chapter I'm going to discuss in the coming video, which will be uploaded soon. If you want to listen to the recording of next content, please subscribe to the channel, and please give me your feedback or your comments or any problems you are facing while understanding or listening to these lessons so that I can clarify them. See you soon, inshallah. Take care, everyone. Bye.